Hold on to your hats, folks, because the stock market is on a wild ride. We've recently seen a steep drop in stock prices. This is what's known as a stock market crash. It can be scary, but remember, knowledge is power. Let's break down exactly what's going on, and most importantly, what you can do about it. We're seeing red across the board. Big names, small names, everyone's feeling the heat. But panicking won't help. Understanding the situation will. So let's roll up our sleeves and dive into the nitty-gritty of this market mayhem. This is serious stuff, but don't check out now. We're going to cover everything you need to know. From why those help-wanted signs are staying up longer to what a currency crash halfway across the world has to do with your wallet. Stick with me, and we'll navigate this market madness together. One of the biggest red flags in this market crash is the lack of hiring. Companies across the US are pumping the brakes on bringing in new employees. Why? Uncertainty. They're worried about the future and whether folks will spend money. When businesses don't feel confident about the future, they hold back on expanding. New hires mean more salaries, more benefits, more overhead. And right now, with so much economic uncertainty swirling around, companies are playing it safe. They're hunkering down, cutting costs, and waiting to see what happens next. This hiring freeze has a ripple effect. When fewer people are bringing home paychecks, that means less money is being spent in the economy. It's a vicious cycle. But fear not, we'll explore ways to protect yourself, even in this shaky job market. Remember, information is your best defense. Remember that economic engine we were talking about? Well, consumer spending is like the fuel that keeps it running. And guess what? Our tank is looking dangerously low. People are worried about the future, and they're cutting back on spending. Think about it. When you're unsure about your job security or see your retirement savings shrinking, are you more likely to splurge on a new TV or tighten your belt? Exactly. And it's not just big-ticket items. Even everyday purchases are taking a hit. This drop in consumer spending is a major warning sign for the economy. It creates a domino effect, impacting businesses, their employees, and ultimately, the entire market. But don't despair. Understanding this dynamic is the first step towards making smart financial decisions in uncertain times. Now let's connect the dots. We've got companies hesitant to hire because they're worried about the future. We've got consumers tightening their belts and spending less. What happens when people buy less stuff? Businesses feel the pain. Their revenue, the money they bring in from selling goods and services, takes a nosedive. Falling revenue is a major alarm bell for any company. It means they have less money to pay their employees, invest in new products, or even keep the lights on. In extreme cases, it can even lead to businesses shutting their doors for good. This is the harsh reality of a stock market crash. The good news? We're not helpless bystanders. By understanding the forces at play, we can make informed decisions to protect ourselves and our financial well-being. So let's keep digging deeper. Section 5. Even Buffett's worried. The Oracle of Omaha dumps Apple. This is big news in the financial world. Even the big fish are feeling the bite of this market crash. The pressure is mounting. Take Warren Buffett, for example. He's not just any investor. This guy's a legend, a straight-up investing icon. People look up to him for his wisdom. He's known for his long-term approach, for buying solid companies and holding on for dear life. His strategy has always been about patience and foresight. So when even Buffett starts making moves, you know it's time to pay attention. It's a signal that something significant is happening. Recently, Buffett sold off a big chunk of his Apple stock. Apple, this isn't a small decision. The tech giant, the company that can seemingly do no wrong, it's a powerhouse in the tech industry. If the Oracle of Omaha is getting out, it's a sign that even the strongest companies aren't immune to the forces at play in this market. It's a reality check for all investors. Remember, I'm not saying to sell everything and hide under your mattress. That's not the solution. Panicking is never the answer. Staying calm and collected is crucial. But Buffett's move is a wake-up call. It's a moment to reassess our strategies. It's a reminder that we need to be vigilant, we need to stay informed, and we need to be prepared for anything. The market is unpredictable and we must be ready. Section 6. It's a small world after all, global markets and you. Here's the thing about the stock market. It's not just some isolated game played on Wall Street. It's interconnected with the entire global economy. What happens in one corner of the world can have a ripple effect, impacting markets and economies far, far away. Take the recent turmoil in the Japanese yen, for example. The value of the yen has plummeted, sending shockwaves through the global financial system. Why should you care? Because a weaker yen makes Japanese goods cheaper for other countries to buy, potentially impacting businesses and jobs right here in the US. The takeaway? We're all in this together. The global economy is complex and interconnected. Staying informed about global events and understanding how they might impact the market is crucial for navigating these turbulent times. Section 7. Money more than just paper. Understanding risk and value. Let's get back to basics for a moment. What is money, really? It's not just those greenbacks in your wallet or the digits in your bank account. Money represents value. It's a medium of exchange, a way to measure the worth of goods and services. And like anything else of value, it's subject to risk. In a stock market crash, that risk becomes glaringly apparent. The value of your investments can fluctuate wildly, and unfortunately, in a downturn, it's usually downwards. Understanding this inherent risk is crucial for making sound financial decisions. Remember, investing always involves some level of risk. But by spreading your investments, diversifying your portfolio, and making informed decisions based on your own individual risk tolerance, you can weather the storm and come out stronger on the other side. Section 8. Yen trouble, currency crashes, and the interest rate roller coaster. Remember the Japanese yen we talked about earlier? Well, its recent nosedive is a prime example of how interconnected the global economy really is. When a currency crashes, it loses value compared to other currencies. This can have a domino effect on everything from imports and exports to interest rates and even the stock market. In Japan's case, the yen's tumble was largely due to the Bank of Japan's decision to keep interest rates ultra low. Low interest rates can make a currency less attractive to foreign investors, leading to a decline in its value. This is a prime example of how seemingly unrelated events in one part of the world can have a ripple effect, impacting markets and economies far and wide. It's a reminder that staying informed about global events is crucial for navigating the complexities of the market. Section 9. Rates go down, markets go. The Fed's Balancing Act. Here in the US, the Federal Reserve, often referred to simply as the Fed, plays a major role in trying to keep the economy on track and stable. One of its main tools is the power to raise or lower interest rates, which can have far-reaching effects on the economy. Lowering rates can make borrowing money cheaper, encouraging spending and stimulating the economy by making loans more accessible. But it can also lead to inflation, which erodes the purchasing power of your money, making everyday goods and services more expensive. The Fed is facing a tough balancing act right now, trying to navigate these complex economic waters. On one hand, they want to support the economy and prevent a full-blown recession, which could lead to widespread job losses and business closures. On the other hand, they need to keep inflation in check to ensure that the cost of living does not spiral out of control. Their decisions on interest rates have a major impact on the stock market and the overall economy, influencing everything from mortgage rates to stock prices. Keep a close eye on the Fed's actions and statements as they can signal important changes in economic policy. Their decisions on interest rates can provide valuable insights into the health of the economy and potential market movements, helping investors make informed decisions. Remember, knowledge is power, especially in volatile times like these, where staying informed can make all the difference in navigating financial uncertainties. Section 10. Batten down the hatches, weathering the stock market storm. So, we've covered a lot of ground, from why companies are hesitant to hire, to how a currency crash on the other side of the world can impact your wallet. The interconnectedness of global economies means that events far away can have a direct effect on your investments and financial well-being. It's a lot to process, but remember, knowledge is your best defense against market turmoil. The more you understand, the better equipped you'll be to make informed decisions. Here are a few key takeaways to help you weather the storm. Stay informed. Keep up with market news, but don't let it consume you. Balance is key. Stay updated without becoming overwhelmed. Focus on understanding the bigger picture and how it might impact your investments. Look beyond the daily fluctuations and consider the long-term trends and economic indicators. Don't panic. Knee-jerk reactions rarely lead to good outcomes in the stock market. Emotional decisions can often lead to significant losses. Stick to your long-term investment plan and avoid making emotional decisions. Consistency and patience are often rewarded in the long run. Diversify. Don't put all your eggs in one basket. Diversification helps spread risk and can provide more stable returns over time. Spread your investments across different asset classes to mitigate risk. This can include stocks, bonds, real estate, and other investment vehicles. Seek professional advice. If you're feeling overwhelmed or unsure about how to navigate the market, don't hesitate to consult with a financial advisor. They can provide personalized guidance tailored to your financial goals. Remember, the stock market is a roller coaster. It's natural to experience highs and lows. There will be ups and downs, twists and turns. Volatility is a part of the market's nature, but by staying informed, staying calm, and making smart decisions, you can navigate the volatility and come out stronger on the other side. Your resilience and informed approach will be your greatest assets. Stay strong, stay informed, and remember, I'm always in your corner. Together, we can weather any storm the market throws our way.